open a business, any kind of business, you have to have capital. Capital is just the word that they use for your startup money. And it doesn't necessarily have to be a lot of money. It doesn't take a lot of money to open a business that is a lemonade stand. But you do have to have enough money to buy the materials to make lemonade, right? So every business requires some form of capital. The most common small business, startup businesses are sole proprietorships. That's just when a single person opens a business. So if I were to go out and open a business, or if you were to go out and open a business, most likely you'd open a sole proprietorship. They're the least expensive to start. They have the least amount of legal paperwork and documents that need to be filed, and they're the easiest to get going. When you have a sole proprietorship, you are personally responsible for all aspects of the business, so that means you're personally responsible for all the expenses. However, the profit, which is the money left over after the expenses, that goes to you. That's all yours, because you own the business. Okay. Now, personal liability. If you are a sole proprietor, you have personal liability, which means that you're personally responsible. So let's say I own, Miss Aiton's Math Emporium, and I'm racking up debt to start my business, and then it fails because it's a math emporium and people aren't going. I'm personally responsible to pay off all those debts, even if the business fails. Okay, and then let's say at my Miss Aiton's Math Emporium, somebody falls down the stairs and injures themselves. I am legally responsible. So a sole proprietor is both financially and legally responsible for all aspects of the business. So these are just things to kind of keep in mind when you are considering opening a business. For example, maybe I should have put a banister on my stairs. If you and your friend, or you and a couple of friends, go into business together, you have a partnership. And partnerships are owned by 2 or more people, and it could be split equally. Like, let's say Miss Ellis and I open the Ellis Aiton Math Emporium. We could go in 50-50 and be split equally, or maybe I had more money to start than she did, and so I own 70% of the business and she owns 30%. So they're not always equally. Sometimes they are. You share the profits and you share the expenses. Yeah.
Can a corporation be personally liable if you don't open an LLC?
If you're not, okay, a corporation is not personally, or people that own corporations are not personally liable, because you've gone through, if you own a corporation, you've gone through the process of incorporating. So it's, I could call my Math Emporium Miss Aiton's Math Emporium Incorporated, but unless I'm actually a corporation, it doesn't mean anything. I had to actually file the paperwork to be a corporation. There's more to it. Which, let's segue into that. A corporation is its own entity. You have to file legal documentation. Usually you hire a lawyer to do this for you to make sure everything's done correctly. There are different levels of corporations. There are public and private corporations. There's limited liability corporations. But a corporation is a business, and it's owned by 1 or more people. I can own a corporation just myself. In which case I probably wouldn't have stock because I'm the only owner. Or it can be owned by thousands and thousands of people. For example, Target is a corporation. Target is owned by probably millions of people. I don't know how many shares of stock they have outstanding, but a lot. Corporations give you limited liability. You are not personally liable if you own a corporation. The liability that you have is in the money that you have put in. So if I take my capital and I start my own corporation, the most I can lose is my capital that I've invested. Nobody can come after my house or my personal things. There's no personal liability. Stock shares represent your ownership in the corporation. So, theoretically, if I owned a corporation, I was the only owner, I would have all the shares of stock. Or if 3 people owned the corporation, they would split the stock amongst the 3 of them. Questions on that so far? Stock. In the stock market, which we'll be talking about a lot in this chapter, if you've purchased stock, you're a shareholder, which makes you a technical owner of the company. So if I go out and I buy a single share of Target Corporation, I am technically an owner of Target. Now, my one little share does not give me a lot of ownership power because, as I said, there's probably millions of outstanding shares. I don't know the exact number, but it's a lot. But I'm still an owner. Being a stockholder gives you limited liability in the corporation. If the corporation should fail, the only thing you can lose is the value of your shares of stock. If the corporation fails and is millions of dollars in debt, the debtors cannot go after all the shareholders for all that debt. All you can lose is the value of your stock. You can't lose anything more. There are public and private corporations. Public corporations are traded publicly, meaning that anyone can buy shares of stock. That's through like E-Trade and Wells Fargo and all the different banks and all the different online trading. I can go out and I can buy a share of Target and nobody can tell me that I can't. If you are a private corporation, private corporations can pick and choose who is allowed to own shares of their stock. They're not traded publicly. In those cases, a lot of times shares are given to employees as bonuses or part of the stock sharing program, or they're given to other companies as to, like, try to entice partnerships or investments, but you just can't go buy shares of these companies. Questions on that? So Michelle has invested $15,000 in a partnership with 4 other people. So it's 5 owners total. She invested $15,000, but the total investments are $240,000. So we want to figure out what percent of the business does she own. So what you're going to do is you're going to take her $15,000 and you're going to divide it by the total $240,000. And in case nobody ever showed you this trick, you can cancel out extra zeros. And it's really just 15 divided by 240, which is 0.0625. And quick question to the right, which gives me 6.25% is owned by Michelle. Now that means that if this partnership is developing a profit, she's going to get 6.25% of the total profits, because that's how much she owns the business. Her liability is also 6.25% of all the liability.
She can only lose her shares, right?
Yeah. No, this is a partnership. Partners are personally liable. However, they're not necessarily equally liable, because she only owns 6% of the business. She's only 6% liable.
How would
Right.
you work that out if they got sued?
Okay, so let's say you were sued.
Well, but like for not for money. Whether she did not have enough money to pay.
Oh, that gets into all kinds of things. Okay. You can also figure out like how many shares you own if you own a percentage. So we want to take this 12% and we need to convert it to a decimal in order to use it. So I'm going to move 2 places from percent to decimal, so to the left, which turns it into a 0.12. And the word of just for reminder, of means to multiply. So I'm going to do 12% times 650,000 shares, which gives me 78,000 shares that Mike owns. When you have weighted partnerships, you can figure out how much money each partner invested using the ratio. And what you want to do is put each of these in front of an X. So this 2, 3, 5 is going to give me a 2x, a 3x, and a 5x. Okay. Then I can take these x's and I can create an algebraic equation. Everything they invested was 900,000. 2 plus 3 plus 5 is 10. If I divide by 10, I find out that x is 90,000. Okay, and that gives me the base number to find out how much each partner invested. So the 2x partner did 2 times 90,000, so they invested 180,000. The 3x partner is 3 times 90,000, so they invested 270,000. And then the 5x partner is 5 times 90,000. So they invested 450,000. You always hear people say the stock market, right? You hear that a lot, the stock market. There's not one. There's a lot of stock markets. Stock market is just a general term for an institution where you can buy and sell stock. There are a whole bunch of them. The two most well-known in the United States, well, it has 2 L's, are the New York Stock Exchange, the NYSE, and the NASDAQ. And usually the NASDAQ stands for National Association of Securities Dealers Automated Quotation System, but nobody ever says that. Everybody says NASDAQ. And nobody ever says NYSE, they say New York Stock Exchange. These are 2 stock markets, but there are a ton of stock markets. There are stock markets internationally. There are stock markets in Tokyo and in Hong Kong and in England and in Russia and in France and South America and Africa. I mean, probably not at the North Pole, but you never know. I don't know. Stocks are traded. A trade is a stock market transaction. Now, you trade stock for money and vice versa. So I can either have money and trade my money for a stock certificate, or I can have a stock certificate and trade my stock certificate for money. And the reason it's called a trade is because it's not like when I go in the grocery store and I just go grab some stuff off the shelf and I buy it. Somebody has to be willing to give up their stock shares for you to buy them. They're not just sitting on a shelf somewhere. Somebody owns them. So they're traded. You're trading with some other owner. Does that make sense? And you can't always buy, and it's rare, but there are times when you're not going to be able to buy the stock that you want to buy. On like talking about the stock exchange or the stock market, the last is the price per share of the last trade made for a stock. Okay, so if I were to go online right now and pull up some stock market data, the last would be the last transaction, which may have been 5 minutes ago or an hour ago. Okay. If I were to go onto a newspaper, it's the last transaction from the previous day because obviously they print the newspapers overnight. So, just depending on what your information source is, depends on if it's a really recent last or if it's a last from like yesterday. But online, if you're on like, CNN on TV will have like the little numbers scrolling across the bottom. Those are stock tickers. If it says, if there's a last on there, it's like probably like a minute or two ago. So now the close is also called the closing price. And this is the last price for the day. Okay, now the day is generally 9:30 a.m. to 4:30 p.m. Eastern Standard Time. Okay. Because the NASDAQ and the New York Stock Exchange are located in New York. Wall Street is in New York. The center of the United States stock trading is in New York, which is Eastern Standard Time. Stock market opens at 9:30 and it closes at 4:30. So the close would be whatever price the stock was at 4:30 when they closed. Now, because of computer technology that we have now, like it used to be back in the day before there were computers, that if you decided at 4:31 that you wanted to buy stock, you were out of luck, it was closed. But now that we have computers and online trading and things like that, there are after hours trades that do happen. But the close is still the price at 4:30 when it closed. Or if you were looking at, say, like the Tokyo Stock Exchange, it would be whatever time of day that place closes. We have no idea what time they close. The high is the highest price of the day. And the low is the lowest price of that day. And stock market prices can fluctuate up and down all day. So you could close lower than your highest price of the day. You could close at your highest price. Your low and your high could be hundreds of dollars apart, and anything can happen, right? It's the stock market. The volume is the number of shares traded in a given time period. Okay, that can be a day. They could say the volume of Google for January 13th was whatever, or that could be for a month, or it could be for an hour, a single trade. It's just whatever the set time frame is. And a lot of times you see it as listings as sales in the hundreds or sales in hundreds or sales in thousands. And so that would be, this tells you how many groups of 100 or 1,000 there are. So it might say like 10 sales of 100 or of hundreds. So that's 10 groups of 100. So that would be 1,000. 10,000. Yeah, 1,000. Low and high. Okay, 52 weeks is a year, right? But they don't talk about, like, they're not saying the high from in a year, like in the year 2013. They're talking about the high in the last year from today. So it's 52 weeks backwards from today. So if we talked about the 52-week high right now, we'd be talking about between now and January 13th of 2013. So it's always a year and it just shifts on a daily basis. Okay. Same thing with the low, so it's 52 weeks. The change, or net change, usually you see this though, is the lowest, or sorry, not looking thing, it's the change in price Okay, so what we do if we're talking about the change is I look at yesterday's, well, yesterday was Sunday, but let's just pretend the stock market was open yesterday. I look at yesterday's closing price and I'm going to look at today's closing price. And then I'll take the difference of the two and that's the change. So it goes from closing price to closing price. So every day at 4:30, somebody's calculating all these changes. Well, sorry, some computer is calculating all these changes. People don't do it anymore, right? That'd be too much work. Okay. If it's positive, that means today was higher. And if it's negative, that means today was lower. Okay, and the change is what analysts look at, those daily changes, to try to identify trends in certain stocks. If the change is constantly positive, that shows a trend of increasing prices, and if the change is constantly negative, it shows a trend in decreasing prices. And sometimes it flip-flops back and forth, positive one day, negative, and all over the place, but they can still use those changes and get what's called a moving average, which I'll show you how to do, that smooths it out and makes it basically a straight line, so you can see if it's in general increasing or in general decreasing to determine what to do with those particular companies. And then, as I mentioned before, now that we have the internet and computers and things, after hours trading does occur. These are trades made after the market has closed.
They will commence when market reopens.
Right? No, they go through that same time because it's all automated now on computers, right? So your after-hour trade still will go through. It's just not reported because the business day for the stock market ends at 4:30. So there's no new data being reported until the next day. So the way you know if after-hours trading has occurred is if the opening, if the open, so we have an open and we have a close. The open is the price at the beginning of the day. So if the open is different from the close from the day before, then you know that after-hour trading happened. So if it closes at $4.25 and it opens at $5, somebody did something overnight.